Hey everybody, Ace here. There are a lot of different things you need to know before you begin investing, so I'm going to walk you through some of the basics. So you're someone who's just looking to start investing and you're not sure where you should put your money, what different accounts you should have. You've heard different terms of 401k, 403b, IRAs, brokerage accounts, and you have no idea what to do. So I'm going to walk you through what each of those are and the basics you need to know about all of them. The first thing we're going to talk about is your individual brokerage account. You need to be 18 years old to open one, but anyone from 18 years old and older can open an individual brokerage account. An individual brokerage account allows you to invest money into the stock market. And there are a variety of different players who allow you to open an individual brokerage account. I'm just going to name a quick few for you. Some that I personally use are Robinhood, Webull, Fidelity, and Vanguard, but a couple others that you could look into would be TD Ameritrade, T. Rowe Price, Charles Schwab. The list goes on and on and on. There are a ton of different financial service providers out there that you can open an individual brokerage account with. That individual brokerage account allows you to invest into stocks, bonds, index funds, different types of ETFs, a wide variety of things. So what you need to know about your individual brokerage account is when you invest money into different assets, that could be your stocks, your bonds, or index funds, when those assets go up in price and you make a profit, you will be taxed when you sell. So let me give you a quick example. You invest into a stock A at $50. Stock A goes up to $100. You just made a $50 profit. When you sell stock A for $100, you will be taxed on that $50 profit. Now, the amount that you're going to be taxed is going to be dependent on how long you've owned that stock. There's short-term capital gains and long-term capital gains. Long-term means that you've held the stock asset for over 1 year. Short-term is anything less than that. So let's say you bought Apple stock, which is over $100 right now, and it doubled its money and it went to $200, and you sold it within 3 months. You're going to get taxed short-term capital gains. Now, Apple, for instance, if you want to buy and hold that for multiple years, then whenever you sell it in the future, that would be a long-term capital gains tax. And you might be wondering, what is the capital gains tax? Well, it really depends on which political party is running the office. Democrats will have a little bit higher of a capital gains tax, while Republicans typically offer a little bit lower of a capital gains tax. But long story short, it doesn't really matter. Just know that you will be paying taxes on your profits. And a counterpoint in that individual brokerage account, when you do lose money on your assets, your stocks or your bonds, you can use that as a tax write-off, and we can get into more of that into another video. But for now, just understand that when you make a profit on your stuff, you will be paying taxes on it when you sell for an individual brokerage account. Next thing you need to know about would be a 401k or a 403b. Now, this is if you're just starting off in your career and you have no idea what those are. A 401k is an employer-offered retirement plan. A 403b is typically offered to people in the public sector, so your teachers, some of your healthcare providers, stuff like that. Starting off with a 401k. There's going to be two different options of a 401k. And I know this is going to get really detailed and really confusing, but I'm going to break it down for you nice and simple. You're going to have a Roth 401k or a traditional 401k. What's the difference between the two? A traditional 401k is pre-tax money. A Roth 401k is after-tax money. So a quick example, if you're investing into a traditional 401k, when you get paid, you have all those taxes taken out for Medicare, state tax, federal tax, Social Security. So if you're investing into a traditional 401k, your money gets put into your retirement account before those taxes get taken out. So it's pre-tax. If you are investing into a Roth 401k, everything's going to be invested post-tax. So you're going to pay your taxes on your Social Security, Medicare, federal, and state taxes. And then the money you have left over, you get invested into your Roth 401k. So really, when you withdraw your money, it's, are you going to pay taxes on it, or have you already paid taxes on it? In your Roth, you've already paid taxes. That means when you withdraw your money when you're older, you don't have to pay taxes anymore. You already did. For traditional, since you didn't pay taxes before, you're going to have to pay taxes when you withdraw. There are benefits to choosing one over the other, and it really depends on who you are and what your situation is. Ultimately, if you're investing in your 401k, whether it be a traditional or a Roth, you can't lose. You're going to be helping yourself out for the future. I've had 5 different employers in my 6-year career, and each 401k plan is different. It depends on the different assets that they offer, the company match that they have, and the vesting schedule that it is. And you might not know what any of those are, so I'll briefly touch on all of them. Each company will have their 401k plan in a different brokerage firm. So it could be Fidelity, it could be Vanguard, Charles Schwab, T. Rowe Price. There are multitudes that you could have your money in, and each one of those are going to offer different assets. So for instance, in Vanguard, you might have options to VTI or VOO index funds, but in Fidelity or Charles Schwab, you might not have access to those. So it really depends on what employer you're with and what they offer. A company match in a 401k. Depending on what company you're with, they're going to offer a match, which means they're going to put money in if you put money in. So for example, if they have a 100% match dollar for dollar, that means every dollar you put in, they're going to put in one at the same. So if you put in $500, they'll put in $500. Now that's not normally how it works. Typically companies are going to put in a 3% match dollar for dollar, and that's it. Or 50% up to 6%, which ultimately means you're getting 3%. So if you put in $100, they're going to match 3% of that. You want to make sure whatever your company match is, you want to take full advantage of it. If they're matching up to 5%, you want to make sure you're at least putting 5% of your paycheck into your 401k to get that company match. Long story short, it's free money. Take it. Take it! Last is the vesting schedule. What is the vesting schedule? Well, that's how long you need to work for a company to keep that sweet, sweet money that they're giving you. Let me give you a quick example. On average, the companies I've worked for have had a 2-year vesting schedule, which means I need to work for them for 2 years to keep the money they put in to my 401k. So for instance, if I put in $10,000 in year 1 for my 401k and they match 50%, so they put in $5,000 as well, my 401k balance will read $15,000. But here's the catch. If I leave within that first year and it has a 2-year vesting schedule, that $5,000 they put into it, I don't get to keep it if I leave the company. But at a 2-year vesting schedule, that means after 2 years of working for that company, that money they put in there is mine. So if you're just starting to work, make sure you know what your company's vesting schedule is, just in case something does happen and you do want to leave that company. If they have a 5-year vesting schedule, you don't want to be stuck there for 2, 3, 4 years just to get that money from your 401k. Moving on to your IRAs, you have a traditional IRA and a Roth IRA. And if you paid attention to the traditional 401k and Roth 401k, there are some similarities. Let's start with the Roth IRA. A Roth IRA is an individual retirement account for post-tax money. What does that mean? With a Roth IRA, you've already paid your taxes on your paycheck, and you're going to invest into your Roth IRA. Since you've already paid your taxes, that means it's post-tax money. When you withdraw money from your Roth IRA when you're older, you don't have to pay taxes on those earnings. With the Roth IRA, you can only put in a max of $6,000 per year. So what is the point of investing into a Roth IRA? Well, the Roth IRA gives you a lot of tax benefits. It's post-tax money that you put in, so when you withdraw your money, it's tax-free. Let's say over the course of 10 years, you're putting in $6,000 a year. So you have $60,000 in that account. That account doubles in money. You have $120,000. And you want to pull that money out when you're old enough, and you can. You pull that money out, it's tax-free. You don't have to pay a single penny on those taxes whatsoever. You just have $120,000 sitting in your sweet old bank account. So with a Roth IRA, you're going to have some of the same assets as your 401k. You're going to be able to invest in stocks, index funds, bonds, stuff like that. The difference between a Roth IRA and a 401k would be a Roth IRA has income limits, so you can only make a certain amount of income to invest. And if you're wondering what that Roth IRA income limit is, you need to make below $137,000. Second is a traditional IRA. This is your normal individual retirement account, and you can still only invest up to $6,000 per year in this account. Your traditional IRA is pretty similar to your Roth IRA. The major difference would be you get some tax benefits, or you could write some money off on your income when you invest into your traditional IRA. So what should you choose? Roth IRA, traditional IRA? Does it really matter? Well, it really depends on who you are, your investment strategy, and what you're looking for. But myself and all of my friends and family have a Roth IRA. Now, I just briefly want to touch on two different investment management styles. There's active management and passive management. Active management is when funds or portfolios are run by a portfolio manager. They will buy and sell different assets for you and manage your fund, typically for a fee. With active management, that typically involves your target date retirement funds or different types of mutual funds. And then you have passive management and passive investing. That's when you're every week or every paycheck, you're putting into your 401k or your individual brokerage account into a typical index fund that tracks the stock market. Passive investing or passive management is your set it and forget it style of investing. Hey, that's the investing I do in my 401k and Roth IRA. Every paycheck, I put money into my 401k or Roth IRA, I invest that into an index fund, and I just watch it grow. 30 years from now, I should easily have enough money to retire. And if you're not quite sure what you should still invest into, if you're just starting your career and you have options to a 401k, think about this. This is what I would personally do. I would put the percent match into my 401k. So for example, if your company matches 4%, put 4% of your paycheck into your 401k to capitalize on that company match, or else you're leaving free money on the table, and then max out your Roth IRA. So you'd be putting $6,000 a year into your Roth IRA, 4% into your 401k, and with your company's 4%, that would be 8% into your 401k, and then you'd be maxing your Roth IRA. That will set you up for success for the future and put you on a great step forward towards retirement. If you like this video, just tap that thumbs up button for me. That'd greatly help me out. Subscribe for more content and leave me a comment down below if you have any questions on my basics to investing. And until then, I'll see you in the next video.